All right, so next I want to talk about the implementation of your default risk management strategy. So we assume that you've got your strategic issues resolved, which I talked about last time, and now I'm going to talk about the functions that you would have in terms of implementation. So the first function is what you might call credit policy. And that's a policy that you develop that tells you what loans you're going to approve, what your criteria are for approving loans, and at what price. So you settle those policy issues. You decide, what do how much do you emphasize credit score versus income ratios versus loan-to-value ratios. You put all those things together and you set your policy. The next thing I put a question mark who. That is, who are you going to work with in implementing your policy? Internally, the focus would be on hiring standards. What type of person would I hire to take a loan application? What type of person would I hire to make an underwriting decision? What type of person would I hire to form a contractual relationship with another company? Things like that. So hiring standards, obviously. And then there what I call counterparty standards. That is, if you're going to outsource your originations to somebody else, a mortgage broker, or if you're going to outsource some of the risk management to a mortgage insurance company, what are the standards that you set for that? How much capital do you want the counterparty to have? What kind of business processes do you want them to have to make sure that they're going to be able to meet their obligations? So that's kind of the who issue. Then there's sort of training and incentives. Training, so for your that's both external and internal. Internal means like your own employees. What are your procedures for training them to make sure that they're going to execute the policy as you intended? Incentives also make a difference there. If you don't give if the incentives aren't aligned with the policy, you can't expect that the policy will necessarily be executed. That also is important externally. If you're going to have somebody originate loans that you're going to take the risk on, you'd better train those people as to what type of loans you want approved, and you better make sure that they have incentives to only give you the loans that you want in terms of your policy, rather than having other incentives that work in the other direction. So the issue with training incentives, I mean, it's a big deal. If it's very common both internally and externally for the incentive to be based on volume. That is, somebody's bonus is paid on the basis of how many loans they approve. Well, clearly, if you're trying to have a credit risk policy, that kind of incentive might be working against you. You need to have an incentive that aligns the people who are delivering loans to you with your policy on what you want to have approved and what you don't want to have approved. So that's an issue. Sort of systems and procedures would be another thing. So if you want to eliminate some human error, you might use automated systems, things like credit scoring systems or automated appraisal systems based on databases, things like that. Now, they may reduce human error, but they could introduce other forms of error, and so you have to think about that. But overall, you have to look at what your systems and your procedures are doing in terms of how they how they work with implementing your risk policy. Another function that I alluded to in a previous talk is quality control. You want to look over the loans that you've bought, or the loans that you're taking the risk on, in order to see whether they actually map properly to your policies, to see whether all your procedures and policies are being followed. In manufacturing businesses, quality control usually involves taking a sample of the final product and testing it against standards. And there's a similar approach to quality control in mortgage lending. Then another method of quality control is what I call a process audit. So you look not just at the results of a process, but you look at the process itself to see where the holes are. So you could do a process audit of another company. Again, if your originations are being, if the loan is being originated by another company, but you're taking the risk, maybe you want to go in and look at their process, their training procedures, everything in their office to make sure that that process conforms to what you want, is going to generate results that are similar to what you want. A process audit is sort of a front-end way of doing quality control. Instead of just looking at the back results, you look at the process that's producing the results. And of course, you want to audit your own processes internally, not just the processes of other companies that are involved in generating mortgage risk for you. You also are going to experience breakdowns, and you have to decide how you want to address those breakdowns. So, let's say somebody on your staff approves a loan that they shouldn't have. Do you fire them? Do you slap them on the wrist? What do you do? If another company delivers a loan to you that is outside of your policy, do you make them buy the loan back? Do you slap them on the wrist? What do you do? Then there's dealing with exceptions. So somebody comes along and says, this is a little bit of outside policy to take this loan, but I really think this would be, broadly speaking, within the company's strategy, even though it falls outside the current policy. Do you say that's okay, or do you not? You discovered during some kind of audit process or quality control process that the payment to income ratio was a little bit off, that that some of the data was misentered on the application form. Do you make a big deal of that, or do you let it go? And in practice, these exceptions often get through in good times. So there's a tendency to get pretty sloppy as long as loans are performing about dealing with exceptions, so that you can kind of without upper management quite realizing it or making a conscious decision to do so, the de facto credit policy of the company can change as it begins to allow more and more exceptions, because they don't suffer the consequences right away, because house prices are rising, and even fraudulent loans will tend to perform in a rising price environment.